Welcome to Stock Talk with Mike. So obviously we've seen a lot of selling pressure in the market the last week and a half or so, and a lot of really good quality companies are seeing their share price continue to sell off, and they're really just a victim of their own success. Like valuations were getting quite stretched. We're seeing a lot of companies up 100, 200, 300%, a lot of PE ratios in the three-figure range. So we were getting pretty lofty. It's not surprising that we're seeing a bit of a correction in those names in particular. But this is the kind of time you want to start looking to accumulate shares of those quality companies you want to hold for the long term. And that's what I've been doing. I've been probably more active buying this last week and a half than I had the back 6 months, the back half of 2020 as far as buying. So today I want to cover 3 stocks that I think are still tremendous upside growth stocks with a bright future ahead of them that are going to grow immensely, but are also starting to look quite cheap from a valuation perspective. So I think downside, even if we see a continued downward market, will be quite minimal, if any, and are good opportunities right here and now. So stick around, and if you're new to the channel, please consider subscribing, and it'd be great also if you'd like this video. Before I get into the stocks, I just want to say, I know we've been hearing a lot about the 10-year bond yields and concerns around inflation as for reasons as to why we've seen this sell-off. Something else that I think has kind of crept into the market that often leads to a classic supply and demand issue that I haven't heard anyone really talk about is just a massive influx of IPOs and SPACs that we saw come public in 2020 and are continuing to see in 2021. And that is very common in a hot market. Companies are way more likely to come public when they think they can come public for a really rich valuation, which they can during a hot market. And that's why you saw so many SPACs come public in 2020, and they're still stumbling over themselves trying to become public here in 2021 as well. So when you do that, and you look here, like in 2019, there was 59 SPACs and 213 IPOs. And then in 2020, it was up to 248 SPACs and 450 IPOs. And then those numbers are continuing to stay really high, expected here in 2021. And when that happens, it basically floods the market with all these new issuance, and money goes into those. And basically, it's like being diluted when you own a company and your shares are diluted. Basically, there's all this flood of companies to the market that people can invest in. And generally that means selling something else. So you have this huge, massive influx of supply, which can really impact stocks as well, at least in the short term. These 3 stocks I'm going to show you now are all big growth stocks, but in this market where we're seeing big growth and high valuation stocks really sell off hard, I think these 3 stocks still have attractive enough valuation now at these levels that they're limited downside risk, but they're far from value traps. So there's a lot of places you can park your money right now, some very safe dividend stocks, etc., that probably have very limited downside risk, but have limited upside potential as well. I think all 3 of these companies have still big upside runways ahead of them and are really attractive buys right now. First on the list is Nvidia Corporation, so ticker NVDA, the GPU processor leader, and they're probably the most pure play AI play out there as well. Also a great play on gaming. So a lot of big disruptive industries. I really like Nvidia. It's one of my core top holdings, and they're trading at $512 a share, at least when I tape this on Wednesday evening. And they're down from $615 a share, so approaching almost 20% off the all-time highs, despite the fact that they just recently reported earnings, and I'm going to show you that in a minute. At these levels, Nvidia's share price is starting to look really attractive. So they have a forward price to earnings ratio, or PE ratio, which is probably the golden standard for evaluating companies as far as from a valuation perspective, of 34.4, which is quite reasonable given the high growth they have. Like that's really not an astronomical PE ratio by any means. And for a high growth company like Nvidia, a great way to evaluate them is looking at their PEG ratio, which is their PE, or their price to earnings ratio, divided by their 5-year expected earnings growth. So that's kind of taking into fact like what earnings are going to look like in the future. And anything under 2 is pretty good. Anything below 1 is absolutely phenomenal, but they have a PEG ratio of 1.59. So that's looking really good. And this is a cash cow. They're very extremely profitable with a profit margin of 25.98%. And look at this quarterly revenue growth from last quarter. This is a company growing at 61%, yet still trading at a very reasonable valuation. And that's why I like Nvidia right here. And in the middle of this market turmoil, Nvidia reported just phenomenal Q4 numbers. They reported revenue on the quarter of $5 billion. Their own guidance and analyst expectations were for 4.8 billion, so they beat there, and it was a year-over-year increase of 61%. They reported earnings per share of $3.10 per share. That was a year-over-year increase of 64%, so they're becoming more profitable while growing revenues incredibly quickly. And analysts were only expecting $2.79 per share in earnings, so they beat on earnings as well. And to top it off, they also provided some great forward guidance for next quarter. They expect revenue to be 5.3 billion for Q1. That would be a 72% year-over-year growth. So that's accelerating revenue growth. So just phenomenal for a company of Nvidia's size. And earnings per share of $3.21, which represents 78% year-over-year earnings per share growth. So again, growing revenues, accelerating the growth of their revenues and their earnings per share. Next is Alibaba, the Chinese e-commerce leader. So they actually had a decent day. Like you look here, this is Wednesday's chart. And despite there being a real bloodbath in the market, and I think that speaks to them having pretty good value because it was really the high valuation stocks that were really getting smashed the most. So I think Alibaba looks like a bit of a safe haven here because they do trade at such an attractive valuation, but still represent a high growth, which is a fantastic combination in this kind of market. So they're well off their all-time highs here of 319 from just 3 or 4 months ago. And they're actually approaching the levels that they were at after that big sell-off we saw a couple months ago, after there was those antitrust concerns around Alibaba that I actually bought really heavily on. And so that was in the 220s and we're at 236 a share. So we're getting right back there almost full circle after going up from those levels around 20-30% or so. So we're about 31% now off the all-time highs on Alibaba right now. And Alibaba is cheap from a valuation perspective. So their forward PE, price to earnings ratio, is under 20 at 19.57 at these levels. And they're obviously a profitable company then at 24.71% profit margin. And despite the fact that they have revenue growth of 36.9% last quarter, so really good growth with a really attractive valuation. I really like it here at these levels. Next is Pinterest. I really like Pinterest here. I think it's gonna fare well, and I think it's a great long-term company. So in the last 2 weeks, in this sell-off, we've seen Pinterest drop about 18% or so off the all-time highs. After hours trading, when I'm filming this on Wednesday night, it's actually at $73.50 a share. I actually have an order in for the low 70s that I'm hoping gets filled tomorrow morning by the time you get to watch this. Like, this company has a market cap of $46 billion. And I think of a company like Facebook, and I'm not saying they're totally comparable, but Facebook's market cap is $727 billion. They're 15 times larger. I don't see them getting as large as Facebook anytime soon, but I can see them being a quarter as big as Facebook, and that would be tremendous upside. And their ability to attract customers as far as advertising revenue, I think upside is just phenomenal still, because people go to Pinterest looking to get inspired to make changes around the house and build things. And like, I think it's just going to be really high conversion rates. And it's just like so much more positivity around Pinterest generally than Facebook. But anyways, that's enough about the company. I want to look at this valuation that they have as well. So their forward PE is 59, which, you know, isn't ridiculously cheap, but this is a really high growth company, and it's not anywhere near the astronomical numbers. We've seen a number of other stocks that I actually really like and hold, that some of them are in the 3-digit kind of territory. So it's somewhat reasonable. When you consider the massive earnings growth and revenue growth of this company, I think it's actually quite cheap. Their PEG ratio, which is, you're looking at that PE ratio but also looking at it divided over their earnings growth over the next 5 years, that is 0.36. That is a disgustingly low PEG ratio. Anything under 1 is considered undervalued, and they have a PEG ratio of 0.36. So from that perspective, and they're expected to have earnings growth over the next number of years, they're trading extremely cheap. And their quarterly revenue growth is 76% in the quarter they just reported. So just a huge growth company. You don't see companies growing north of 50% on a quarterly basis trading at these kind of valuations. There's a few ideas there for you as far as companies that are still got high growth, but are also starting to look pretty attractive from a valuation perspective. But I have been also just actively adding. I love adding on a down market to my high conviction stocks, especially when you're seeing like indiscriminate selling like this. I still got lots of cash available to continue to add if we see more downward pressure. And I realize we might have more downward pressure, but I don't want to wait for some kind of market bottom. I want to take advantage of some of these drops, especially as we see stocks kind of hit 20% or more off the all-time highs. And then I'd be adding even more if I saw some of them drop about 40% off the all-time highs. When you start panicking about a company you hold, you need to think about why you bought that company and if anything fundamentally has changed about that company other than the fact that its share price has gone down. If the company is still executing and you still like the company and all that's happened is the share price has gone down, that company is more attractive. It's delivering, but it's also trading cheaper. And that's the beauty of the stock market. That's when you want to start adding, accumulating shares and adding for the long term, and things will sort themselves out. These high-flying growth stocks with rich valuations, yeah, they're going to come down in valuation, but they're also going to continue to kill it from a revenue perspective and earnings perspective. And as that happens, they're going to grow into their valuations and they're going to meet somewhere in the middle and continue their trajectory upwards. So please don't panic. All right, happy investing, and we'll talk to you next time. Take care.